Tax season arrives every year, and for freelancers, professionals, and small business owners, it often brings a wave of confusion and stress. For financial year 2025 to 2026, which corresponds to assessment year 2026 to 2027, there have been important updates that make this form even more accessible. Understanding who can use this form, what documents you need, and when to file can save you time, money, and unnecessary headaches. Let's start with the most fundamental question. Are you eligible to file ITR-4? This form isn't for everyone, but if you qualify, it can significantly simplify your tax filing process. You can file ITR-4 if you are a resident individual, a Hindu undivided family, or a partnership firm, excluding limited liability partnerships. Your total income must not exceed 50 lakh rupees. Beyond this basic requirement, your income sources must fit specific categories. One significant update for this assessment year is that you can now include long-term capital gains under Section 112A from listed equity shares or mutual funds, up to 1,25,000 rupees. However, this is only allowed if you have no brought forward capital losses from previous years. If you earn from business or professional activities, your income must be computed on a presumptive basis. This means you're using the simplified calculation methods provided under Section 44 AD, 44 ADA, or 44 AE. These sections allow you to declare income as a percentage of your turnover without maintaining detailed books of accounts. Salary or pension income can be included in ITR-4. Another welcome change this year is that you can now report income from up to 2 house properties, whereas previously, this form was more restrictive. Income from other sources like interest, family pension, and dividends also qualifies. Agricultural income is permitted, but only up to 5,000 rupees. Now let's talk about who cannot use this form. If you're a non-resident Indian or a resident but not ordinarily resident, ITR-4 is not for you. Anyone with total income exceeding 50 lakh rupees must use a different form. If you serve as a director of any company, you're ineligible. The same applies if you hold unlisted equity shares. Taxpayers with income from foreign assets or foreign sources cannot use this simplified form. Here's an important restriction. If you have brought forward losses from previous years or losses you need to carry forward under any income head, you must file a different return. Similarly, if your agricultural income exceeds 5,000 rupees, ITR-4 is not the right choice. Once you've confirmed your eligibility, the next step is gathering the necessary documents. Even though the presumptive taxation scheme exempts you from maintaining detailed books of accounts, you still need specific paperwork to verify your income and ensure accuracy. Form 26, AS, along with the annual information statement and tax information statement, are crucial. These documents help you cross-verify tax deducted at source, tax collected at source, advance tax payments, and all high-value financial transactions that the tax department tracks. Any mismatch between your return and these records can trigger notices. If you earn a salary alongside your business or professional income, you'll need Form 16 from your employer. This document details your salary income and the tax already deducted. Bank statements serve multiple purposes. They're necessary for calculating interest income accurately and for declaring your year-end bank balance, which has become a mandatory disclosure in recent updates. For your business activities, maintain a summary of your gross receipts, turnover, and the breakdown between cash and digital payments. This information is essential for computing your presumptive income correctly under the relevant sections. If you're opting for the old tax regime to claim deductions, you'll need investment proofs. These include documents for deductions under Chapter 6A, such as Section 80C for investments in provident fund or life insurance, and Section 80D for health insurance premiums. Home loan statements or rent receipts are required if you need to report house property income or claim housing-related deductions. Timing is everything when it comes to tax filing. Missing deadlines can result in penalties that eat into your hard-earned money and restrict certain benefits. For financial year 2025 to 2026, there's good news. The government has extended the due date for filing ITR-4 for non-audit cases to August 31st, 2026. This extension provides additional breathing room for taxpayers to gather documents and file accurately. However, if you miss this deadline, consequences follow. You may face a late filing fee of up to 5,000 rupees under Section 234F. Additionally, penal interest on any unpaid taxes will be charged under Section 234A. Beyond financial penalties, late filing can also prevent you from carrying forward certain losses. Now let's walk through the actual process of filing ITR-4 online. The e-filing system is designed to be user-friendly, but following the right steps ensures a smooth experience. Before you even begin, make sure your PAN is active and linked to your Aadhaar. This linkage is mandatory. An unlinked PAN becomes inoperative, which will lock you out of the e-filing portal and create significant complications. You must also pre-validate at least one active bank account on the portal. This step is crucial for receiving tax refunds directly and without delay. The validation process is simple and can be done through the e-filing portal itself. Here's a critical decision point: choosing your tax regime. The new tax regime is set as the default option. If you want to claim specific deductions available under the old tax regime, you must explicitly opt out by filing Form 10 IA before submitting your ITR-4. Keep the acknowledgement number from this form handy, as you'll need to quote it in your return. To access the filing system, log into the official income tax e-filing portal using your PAN and password. Navigate to the e-file menu, select Income Tax Returns, and then choose File Income Tax Return. Select Assessment. Year 2026 to 2027. Choose the online mode and select ITR-4 as your form. One of the conveniences of online filing is that the portal automatically pre-fills much of your information. Your personal details and major income sources are populated from your annual information statement and Form 26AS. However, don't assume this data is perfect. Carefully cross-check every pre-filled field against your physical documents and records. When you reach the Financial Particulars section, accuracy is paramount. For your business income, ensure you input your gross receipts correctly. Pay special attention to newly added mandatory fields, particularly your year-end bank balance and specific asset investments. These fields are now tracked more closely by the department. After filling in all sections and reviewing your return thoroughly, you'll submit the form. But here's where many taxpayers make a critical mistake. Submission is not completion. You must e-verify your return within 30 days of filing. Without verification, your return is considered invalid. The fastest verification method is generating an Aadhaar OTP, which takes just minutes. Alternatively, you can use net banking if your bank supports this feature. Some taxpayers prefer sending a signed physical copy of ITR-V to the centralized processing center, but this method is slower and less reliable. Filing ITR-4 under the presumptive taxation scheme is designed to reduce your compliance burden. The recent updates for assessment year 2026 to 2027, including the ability to include certain capital gains and income from 2 house properties, make this form accessible to more taxpayers than ever before. The key to stress-free filing is preparation. Start gathering your documents well before the August 31st deadline. Verify that your PAN and Aadhaar are linked and that your bank account is pre-validated. Decide which tax regime benefits you more and file the necessary forms if switching regimes. Take advantage of the pre-filled data on the portal, but always verify it against your records. Small discrepancies can lead to notices and delays in processing. Once you file, don't forget the crucial step of e-verification within 30 days. Tax compliance doesn't have to be overwhelming. With the right information, proper documentation, and timely action, filing your ITR-4 can be a straightforward process.